I'm starting the recording.
Okay.
Hello everyone. On behalf of the Finance Club IIT Patna, I Madhur Jain welcome you all to a very special guest session. Today we have Mr. Aswadamodaran sir as our guest, who is a corporate finance and valuation professor at Stern School of Business, NYU. Popularly known as Dean of Valuation, we all know him for his amazing lectures on the above topics, as well as from the best-selling books on valuation, corporate finance, narrative and numbers written by him. We are extremely honored and grateful that he has accepted our invitation today and will share his insights on the topic valuation across the corporate life cycle. The audience members can ask their questions by raising their hands at the end, and we will unmute themselves one by one. Over to you, sir.
Okay, thank you. First, you don't have to wait till the end to ask me questions. You can jump in at any time. Second, if you can turn on your if you can turn on your video, go ahead. I hate talking to a set of names. Let's see what happens if our broadband breaks if you do all turn your videos on. Come on, this is with technology that you can't turn videos on. Let's do it. So as many people who can turn their videos on, go ahead, so I can see you all. Doesn't matter as long as you're dressed. I don't care. You can be in your pajamas. It's late in the evening, so you're completely okay. Um, oh, that's much better. So I see some faces now. Hey, good. Okay, so you guys are engineers, huh? Interesting. I don't think I've done an IIT group before. I've done a lot of IIM groups. I've done a couple of IITs in places I don't even know there was an IIT to begin with. So today's session, originally Madhur asked me to talk about, I don't even know what he asked me to talk about, but it wasn't something I didn't want to talk about. So I chose a different topic. And the core idea for my topic is that there's a corporate life cycle, that companies are born, they grow up, they get old, and then they die. Sounds morbid, but companies go through a life cycle. And it's actually a structure that I use in almost all of my classes. I teach valuation, I teach corporate finance, I teach investment philosophies. In all of those classes, I use this structure to talk about, how to think about companies. So what I'd like to do is first introduce the structure so you have a sense of what I'm talking about, and then talk about how it helps me in different contexts. So feel free to jump in at any time if you have questions as we go along. You don't have to wait till the end. Yeah. Before I go any further, what is your background in, what finance classes have you taken? So, you know, anybody want to jump in and give me a sense of what finance classes you've taken? If any sense of business classes, what have you taken? Go ahead, Faizan. What have you taken?
So, hi, sir. So, actually, I have completed the Bachelor of Commerce last year, and currently I am pursuing USCMA. I have passed one part, and one more is to go.
So even though this is hosted by IIT Partner, you're drawing an audience that's very diverse. Is that right? So I
Yes,
just want to
sir.
make sure. So you did finished your
Sir,
BCom, and what
actually,
did you say you were doing?
USCMA, sir. I have
Okay,
completed first part. One more part is yet to go.
okay. And how about you, Ravindra? Have you taken a bit of finance class before, a business class? Anybody else? Anybody had taken a valuation class, a corporate finance class?
sir, I have personally seen many of your videos available on YouTube related to valuation and corporate finance.
But in your classes, you haven't taken any classes. So basically, it's more. Okay,
Yeah,
that's,
Professor. Excuse me.
yeah, go ahead.
Yeah, so I have taken like I'm in my second year of MBA, so I have taken a few security analysis classes and the general
A
investment banking
few
and M&A
security
classes.
analysis classes? How many do they
So
need to
there
get
are
to
there
when
are
analyzing a security?
so in India there are different there is security analysis one and there is security analysis two. So the second
That
part
tells me absolutely nothing. You can do security analysis one, two. So what do you do in one and what do you do in two?
so one just tells you about your basic instruments or your securities.
Why do you need a whole class to do that? Why couldn't you just read it up?
The syllabus over here is like that. So
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 the first class
there
is a
is
descriptive
the
class, and the second class you actually handle. So the first one is a security describing class, and the second one is a security analysis class. Guy, your MBA programmers need a lot of classes to fill up the 2 years, I guess.
definitely. So there is a fun part. So I take my classes there, and I take a simultaneously another class on YouTube, which is your class. So
Which one are you taking? The corporate finance or the valuation?
uh, actually, I'm going through your 2021 lectures, which are recorded online. So they are
They're
quite
all
clear.
recorded online.
No, no, no,
2021 was my
no.
entire Zoom class. That
Yeah,
class
the
was taught
Zoom class
entirely on Zoom.
because
Yeah.
it's a more clear. You're not you're very much focused to the camera, and I can get things very clear
Right,
in
because
that class.
otherwise you get the classroom
Yeah,
vibe.
you're moving and things
Yeah.
like that.
So anybody else want to dig in and tell me what your background is? Any of you work right now? Any? Go ahead. I can't see your name, so go ahead.
Hi, I'm Neha. Actually, I'm working as a management consultant. I'm in the investment banking background right now. It's been like 4 months for me that I've started working, and I'm a chartered accountant.
So who do you work for?
So I work for a firm known as Prequate Advisory, based out of Bangalore.
And who do you advise? Who are your clients?
So our clients are mainly startups. Like for the investment banking part, our clients are startups. So we make their financial models and pitch decks. Also, we have SFO clients. Yeah.
Okay. So your clients are startups, but
Yeah, mainly, or like,
what do they use you for? So you said financial models. What exactly are you
yes.
modeling? These pitch books for
So,
investors that they're pitching so they can raise money?
yes. So we make financial models for them to go and pitch their business to say HNIs or banks or
Okay.
yeah, or
And
venture
raising money.
capitals, yeah, raising
Okay.
money. So we have to do valuation for that. So
You don't
my
need to do
manager,
evaluation. You need to do pricing for that.
no, so we also value the business based
You
on
don't.
financial
You don't. You build
okay,
models that look like valuation models, but you price companies because you're raising money.
true.
And I think it's good to get rid of illusions. I mean, you might create what looks like a discounted cash flow model, but the
Hmm.
reality is you're raising money. So there's probably an exit multiple in there somewhere and a pricing in there. So it's just a forward pricing
Right.
masquerading as a valuation. I'm not meaning to pick on you, but whenever you talk about VCs and startups, it's better to be clear about what they do. They don't value companies, they price them. Okay, so let's get started. What I'd like to do today is give you a tool that you can use no matter what you do, whether you're in corporate finance, you're in valuation, you're in whatever you decide to do. And the tool basically is the structure of a corporate life cycle. Let me describe what a corporate life cycle is. Corporate life cycle looks very much like a human life cycle. A startup is like a baby, needs constant care and attention. Capital, in this case, instead of mother's milk. A very young company is like a toddler, falls, gets up, sometimes falls and doesn't get up. You grow through the startup years and the toddler years, you become a teenage company. What do teenage companies do? Every day they wake up, they look in the mirror and they ask, what can I do today to screw it all up? I have lots of potential. So the teenage companies do things and you say, really? You want to do that? And then you get to the peak of your life. The company's at the peak of its life. Everything it touches turns to gold. Every project looks great. Management can't make any mistakes. Facebook and Google 5 years ago were companies at the peak of their lives. 5 years ago, no longer are. Enjoy the moment. It's not going to last because then you become middle aged. Let me ask you a question. How many of you are looking forward to becoming middle aged? Anybody in this group are looking forward to being middle aged? Nobody does, right? That's for your parents and your uncles and I. I mean, who wants to be middle aged? But the reality is, you will all get to be middle aged unless something worse happens to you, which is you don't make it to middle age. But if you make it to middle age, you wistfully look back and say, I wish I was young again. But enjoy middle age while it lasts, because what's coming after middle age? It's old age, and then after old age comes dementia, and after dementia comes death. Companies go through this life cycle. My first step when I look at a company is put it on the life cycle, because everything I do with the company, everything I think about the company, every analysis I do for a company reflects where it is in the life cycle. So as I said, I teach, so if you think about what you're doing at each stage, startups, you basically have an idea for a business. You might not even have a business. You're working on converting an idea into a business, converting into a product to service, into a business. When you're a young growth company, you're creating a business model that takes the idea and makes into products and services. Do you have to make some compromises? Absolutely. A founder who refuses to compromise is never going to have a business, because he's going to say, look, this is a perfect product. This is not quite it, so I'm not going to do it. In high growth, you're building the business up. Mature growth, your big growth is done, but you're still looking for growth in places you can find it. It's more opportunistic. Become a stable company, your growth is low, not because you don't want to grow, but you're a big company in a mature market. In decline, you're starting to shrink as a business. So let's use this framework to talk about what it is that determines the life cycle and why it might be different for different companies. So you enter a business. Think about how quickly the life cycle unfolds for your company. If you're in a capital intensive business, let's say you're in the business, an automobile business, takes a while, right? Because you got to raise capital, you got to build factories, infrastructure companies. It's going to take a while before your business builds up and becomes big. So it'll take maybe decades even to get from nothing to being a big company. In contrast, if you're a software company, you can go from 0 to billions in 5, 6, 7 years. If you're an intermediary like Paytm, Zomato, think of how quickly you can grow, because there's no capital intensity, there's no factories, you enter the business quickly, there's no customer inertia, you grow quickly. If I gave you a choice as to whether you want to be an infrastructure company or a fast-growing tech company, which one sounds more attractive to you? You can jump in. Would you rather be a fast-growing tech company, or would you rather be a slow-growing infrastructure company?
Fast-growing tech
Going
company.
tech company.
Everybody picks fast-growing, right? In fact, in the last decade, those are the companies that have become the stars. Silicon Valley celebrates them, and India's version of Silicon Valley also celebrates these companies. Look how quickly they grow. But life is full of trade-offs, and business is also full of trade-offs. The same forces that allow you to grow quickly are also going to be the forces that work against you once you become big. Because once you become big, you want to stay at the top for a long time, right? Because that means you can harvest your success. But if you're a company that is in a business that can grow quickly, guess what? You don't stay at the top very long. And when you start shrinking, you shrink very quickly, because the same forces that allowed you to enter and grow quickly are going to allow other people to enter and subvert your market, take away your market share. I'm already laying the foundation for why, even though businesses go through a life cycle, that life cycle can be different in different sectors, in different businesses. So I'm going to start with a sense of why this matters. When you look at companies, what's the first thing, if you are asked to analyze a company, evaluate a company, what's the first thing you look at? You look at financial statements, right? Accounting statements, income statements, balance sheets, statements of cash flows. And what are you looking for? You're looking for clues about what the company's business model looks like, how profitable it is, how fast it's growing. We all do this. Ian, let me ask you a question. When you look at those financial statements, would you like to see a lot of information or not very much? And the answer is, hey, we'd all like to see years and years and years of data. And if you have a mature company, guess what? You are going to see years. And so you take Tata Motors, you have 50 years of financials. You can go through those financial, but you're not doing it to understand the past, but because you want to get clues about the future. So if you take an accounting class, you're taught how to do ratios because let's face it, accounting, valuation, corporate finance classes are all designed for looking at mature businesses. So when you look at the ratios, so you can compare 20 different ratios and say, hey, this company is extremely profitable. And that's how we've churned out generations of business people to be able to look at mature companies. But an accounting balance sheet reflects what you've already done as a business, right? Basically, they reflect your history, they reflect what you have on the ground. The reason I say that is there's another structure I use in my classes that I find useful to understand companies. You've all seen accounting balance sheets, right? What does an accounting balance sheet tell you? It tells you what the company owns, it tells you what the company owes, and it tells you how much the equity in the company is worth according to accountants. It's a recording of a company's history. And of course, accountants being accountants, what do? They have hundreds of rules. You can't do this, you can do this, and this is how you do this. So accounting statements reflect accounting rules, and this is what you take an accounting class to understand. So if you become a CPA, this is your arena. You churn out accounting balance sheets. So you take a couple like ITC. What do you see in their accounting balance sheet? Everything they've done over their history, and it's a long history, right? You're going to see the residue of the cigarette business and how much cash it's thrown off. You're going to see the hotels they own, the consumer product business. It's a reflection of what you've already done as a company. And guess what? For a company like ITC, you're going to learn a great deal about the company by looking at the accounting balance sheet. It reflects what accountants see on the ground in your company. When I look at a company, I create what's called a financial balance sheet. You're saying, what the heck is a financial balance sheet? In a financial balance sheet, I don't care what accounting thinks. I couldn't care less about accounting rules. When I look at a business and I look at its value can come from two places. Things it's already done, assets in place, investments it's already made, and a second grouping that I'm going to call growth assets. You're saying, what is that? That's a value I'm attaching to things I might expect you to do in the future. I'm giving you credit for things you haven't even thought about yet. I think that's crazy. Why would you do that? Hey, don't we do that when we buy shares in a growth company? What are you paying for? I mean, if you buy Zomato for the 55 rupees or 60 rupees or 65 rupees it's trading for, I hope you're not paying for things they've already done because they haven't done much. They haven't delivered any earnings or cash flows. You're doing it because you think they have potential. You're paying for growth assets. You can never show this in accounting because there'll be too many rules that stop you. But in finance, when we look at companies, we break down value, things you've already done, assets in place, and expected things that you will do in the future, growth assets. And of course, there are only two ways you can fund a business. You can borrow the money, we'll call that debt. And you can use your own money, which we can call equity. But the difference here is the equity in a financial balance sheet is not a reflection of your history as a company. It's a reflection of your potential as a company. He's saying, when will the two converge? If you have a mature company, not much in terms of growth assets, right? Much of what it's done, it's already done. There's no growth coming in the future. Guess what's going to happen? Your accounting and your financial balance sheet will converge. So what you see as the book value of equity in the accounting balance sheet and what you pay for the equity might be very close. But if you're looking at a young growth company, guess what you're going to see in the accounting balance sheet? A reflection of its history, right? And how much history is there? Not much. You look at Zomato's financial statements, there's not a whole lot you're going to learn about the company by looking at those statements. Why? There's not much there. It's not because they're holding back. It's because they haven't done much. It's like asking a 10-year-old to write their autobiography. What's going to be in there? I was born, then around 4, I went to kindergarten. I got into a little trouble when I was in second grade. But here I am at the age of 10. End of the biography, right? That's why you wait till you've done something to write a biography. But accountants do financial statements for young companies, and there are people who are delusional enough to think, hey, if I look at those financial statements, I will learn about the company. You will not learn much about young companies by looking at their financial statements, not because they're holding back, but because there's not much there. So that's the first message I want to deliver. If you're working with young companies, don't spend hours and days poring over financial statements and computing ratios. It's a complete waste of time. Somebody's mic is open if you can turn it off, please. So here's the bottom line. Accounting statements get less and less useful the earlier you are in the life cycle. As companies age, their accounting statements start to get more resonance. If you look at Infosys or TCS, 2 years after they were founded, you'd have seen very much what you saw with Zomato. There's not much there. Today, when you look at Infosys and TCS, they are mature companies. They're companies with significant substance to them. You can value an Infosys or a TCS using financial statements and get away with it because they've moved up the life cycle. As companies age, balance sheets get more meaning, more substance, because more of what the value comes from what they've already done. A great deal of valuation in India until very recently was balance sheet valuation. You know what a balance sheet valuation is? You asked an appraiser to come in to your business and value it. They'd ask you for your balance sheet. They'd look at what you owned. They'd tally up what you owned and say your value for your business is your land, your building. Basically, they were recording what you'd already invested in the company. And they weren't wrong. For a mature business, that might not be a bad way to approach value. But if you were Zomato and you called me in to value you as a company, and I said, hey, show me what you already own. You don't own much land. Okay, you're not worth much. That's a pretty little unfair, right? Because much of the value comes from things they will do in the future, not what they've done already. And there's this area of accounting now called fair value accounting that, in my view, is an oxymoron. You can either do value, you can do accounting, you can't do both. But in fair value accounting, here's what accountants try to do. They try to get balance sheets to reflect the fair value of the company. It's never going to work. And here's why. You can compute the fair value of things you've already done. So you can take the existing land and say, I bought it 20 years ago. Here's the fair value of the land today. But you can't do a fair value of things you will do in the future because you haven't done them. So fair value accounting is a train on a destination to nowhere. But accountants love it because it gives them more work to do. They can charge people more money. Let's face it, without fair value accounting, there would be no Deloitte. There'd be no Ernst & Young. Because 50 to 75% of the valuation work that accounting firms do is just accounting valuation. It's kind of pointless. It's like moving the chairs on the Titanic after you've hit the iceberg. They basically go into the balance sheet and say, you know what, this is worth twice as much as what you thought it was. It's a huge business for accounting, but it's not valuation. So what I'd like to start with is the first class that I teach. I teach two classes of the MBAs. I teach corporate finance to the first year MBA. So actually start the class next week. So these are people coming into the MBA program at NYU the first year in the spring semester. We're in a semester system, fall and spring. So they've taken one semester of classes already, during which they've taken an accounting class usually. But remember, many people who come into MBA programs now have very diverse backgrounds. It's not like 40 years ago where you had bankers and accountants and business people. I have dancers, I have museum directors, I had a couple of basketball players in my class last year, because they're drawn a diverse audience. What I'm trying to say is many of the people who come into my corporate finance class have never taken a finance class. They've never worked at a business. They have zero background other than that first accounting class they've taken. So my corporate finance class starts assuming nothing and builds up. And in my corporate finance class, I talk about the three core principles that drive corporate finance. So I'm going to give you all of corporate finance in a nutshell. Here's the first principle. It's called the investment. So basically, everything that a business does falls into three buckets. It can be investment decisions, you can have financing decisions, you can have dividend decisions. What's investment decisions? Investment decisions are choices you make about what projects to take, whether to do an acquisition. It's deciding where to invest your money. Financing decisions about where to raise the money. Should I borrow the money or use equity? And if you're borrowing the money, should I borrow from a bank or issue bonds? And dividend decisions are decisions about how much cash to give back to the owners of the business. This is not just for companies, right? You run a private business. Do you have to make investment decisions? Absolutely. You have to decide where to put your money. You have to make financing decisions, you better. Otherwise, where's the capital going to come from? Do you have to make dividend decisions? That's the reason you're running the business, to be able to take cash out of the business. And I'm going to state the first principles that should govern how you make these decisions. When you make investment decisions, the investment principle says go out and find projects, investments, assets that earn a return that is greater than some minimum acceptable hurdle rate. Let me back up there because a couple of buzzwords in. Minimum acceptable hurdle rate, what is that? The minimum acceptable hurdle rate is a hurdle rate that reflects the risk of a project. Riskier projects should have higher hurdle rates than safer projects and should reflect where you get the money. So it's not rocket science. So for a risky project, you might say, look, I need to make 20%. For a safe project, you might say 15% is good. For a guaranteed project, you might settle for 7%. That's common sense, right? Riskier projects need higher hurdle rates. And when we talk about returns on projects, you know what is to be based on? Cash in, cash out. As opposed to what? You can show me all the accounting earnings you want for the project. I don't care. It's about cash flows. And when I do returns, not only do I base them on cash flows, I base them on when I get the cash flows. Would you rather get cash flows early or late? Don't think too long. Go with your gut. So if I gave you a choice, would you like to get 100 million now or 100 million a year from now? What's the answer going to be?
100 million now.
100 million now. Why? You
Now,
don't need any present value equations. It makes sense, right? 100 million today is worth more than 100 million a year from now. There's a time value to money. Your return should reflect when you get the cash flows. It should have all side effects built into it. There's no garnishing allowed in investment analysis. What's garnishing? It's after I do the numbers, you say, but there's synergy, there are strategic considerations, there's control. No, 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 no. If you want to bring those in, bring them into the cash flows. There's synergy, bring it into the cash flows. It's strategic. Tell me what's strategic about it. I'll bring it into the cash flows. So return should be based on cash flow, should reflect the timing, should have all side effects. The hurdle rate should reflect the risk of the investment and where you get the money. Investment principle says make sure you take investments that earn more than your hurdle rate. Strike you as common sense. If it costs you 12% to raise money, what am I asking you to do? Please, please, please don't take investments that make less than 12%. You're saying I need to take a corporate finance class to know this? You don't have to. In fact, I would argue that many people who take corporate finance classes take them because they can forget this lesson and take whatever they want to do. You know that 60% of companies globally at the start of 2023 earn less than their cost of capital. Cost of capital is a rough measure of your hurdle rate. 60%. That's 25,000 companies out of 47,000 publicly traded companies. Take projects that earn less than the cost of capital. Why? You're spending other people's money. You're in denial. Why, in God's good name, would you ever start an airline? It's a bad business. But does that stop people? No, they keep starting airlines. I mean, look at India. Every 5 years, new airline comes in. 15 years later, it's bankrupt. They start. It's like the definition of insanity is you keep doing the same thing over and over again, expecting a different outcome. In some businesses, you have to say, these people are insane. It's an investment principle. The financing principle looks at how much money you should raise from debt and how much from equity. I'll give you the very simple rule that's going to govern that choice. Find a mix of debt and equity that minimizes your hurdle rate. Notice what I said, your hurdle rate. There's no one mix that works for everybody. For some companies, that mix might be all equity. How much money should Zomato borrow? Don't think too long again.
Zero.
Zomato is a money-losing, cash-burning machine, right? When you're a money-losing, cash-burning machine, how much should you borrow? Are you out of your mind? Why would you want to go borrow money? And what's the first rule when you're in a hole? Stop digging, right? Young companies should be 100% equity funded. You're saying, but I can't, I have to borrow money. Why? Why did you raise equity? I can't. It's you won't. It's not that you cannot, it's you will not. You know what stops Indian companies, especially young Indian companies that need capital, from raising equity? To raise equity, what do you have to do? You have to go issue shares to the market. When you issue shares, what does it do to your ownership stake if you're the promoter or the founder of a company? It reduces your stake. It's a choice between control and good sense. And guess which one wins out every single time? It's control. So you want to do the insane thing of borrowing money as a young company, do it, but do it with open eyes. This doesn't make sense. The financing principle says find a mix of debt and equity that minimizes your hurdle rate. You ask me what kind of debt should I borrow? Long term or short term, rupee or dollars? Let's cut to the chase. You know what I'm going to ask you? Tell me something about your projects. If you're a typical project, you're an Indian technology company, typical project lasts 3 years, don't take on long-term debt. But if you're an infrastructure company in India, you build roads, toll roads, your debt should be long-term. And if your toll roads are all in India, what currency should your debt be in? It should be in rupees. This again is not rocket science. Your debt should match up to your assets. You know what Indian CFOs will tell you? But it's so much cheaper to borrow in dollars. Just an absolutely stupid statement to make. That's analogous to saying it's twice as hot here today than it is wherever you are. And it is technically. What's the temperature today in where you are, Faizan? What's the temperature today? You
It's
don't have to
around
look at your iPhone. Roughly speaking, what was it today?
the minimum, it should be 9 to 10 and max 20
9.
in Delhi.
Okay, maybe 15. You know what it was here today? 45. What's the difference though? Faizan was giving the temperature in, if you look across India, what's the temperature? It's in Celsius, right?
Celsius.
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 The temperature I was giving you was in Fahrenheit.
Is Fahrenheit.
Is 45 greater than 9? Absolutely. Is 45 degrees Fahrenheit higher than 9 degrees Celsius? We're in a different game, right? Because you got to multiply 9 by 1.8, add to 32, and you go through the math. But that's exactly the problem when a CFO in India tells you, borrowing money in dollars is cheaper because it costs me only 8%, but borrowing in rupees, it costs me 11%. Is 8 lower than 11? Yeah. Is 8% in dollar terms lower than 11% in rupee terms? I don't know, because that depends on inflation and currencies. You can't compare numbers in different currencies, but people do it all the time. You'd be surprised how many Indian companies borrow in dollars because they claim it's cheaper. Remember the Celsius Fahrenheit analogy, because that is what you need to pull out when people compare apples and oranges or things in different currencies. So financing principle says borrow the right amount of money, one that minimizes your hurdle rate and match your debt up to your assets. The dividend principle. Remember that why does a farmer sow seeds in a field? Is it because the farmer likes to watch crops grow? That might be it. But what's the end game for a farmer? You harvest the field, right? At the end, that's the end game. Why do you start a business? Because you like to watch it grow? Yeah, that might be part of it. But the end game for a business is grows enough and it's successful enough. What should it be able to do? Return cash to the people who started the business. That's the end game. Don't lose sight of that end game. Paytm's end game is not adding users. It should be to make money. Somewhere along the way, Paytm's founders seem to have forgotten this, and somebody needs to remind them adding more users is not the end game here. You guys have to figure out how to monetize these users and make money on them. The dividend principle says if you cannot find investments that make your hurdle rate. Give the money back to the owners. Let me repeat that again. If you cannot find investments that make your hurdle rate, give the money back to the business. You know what the response of many CFOs and CEOs is? If we do that, we will get smaller. True. We will shrink. So what? We might go away. Great. A company is a legal entity. The notion that you want the company to live forever is both unrealistic and stupid. Forcing companies to live on well beyond the due date is just going to mean they suck up resources. They don't have to. So that's corporate finance in a nutshell. I spent 26 sessions fleshing out how to bring risk into hurdle rates, how to convert cash flows into returns, but it's all icing on the cake, right? This is why you can be a great business person without ever taking a corporate finance class. If you get those first principles, you're going to run the business. Remind me again, where did Dhirubhai Ambani get his MBA? Oh, he dropped out in 5th grade. I forgot that. But you know what? He understood the first principles. I'll wager that if McKinsey came in and did a little dance in front of Dhirubhai Ambani, said, if you do this, you're strategic, he's probably going to say, look, that's all nice, but tell me what my cash in is and cash out is. And I'll tell you whether this is a good investment or not. Sometimes going back to basics is the best counter to all the dances that consultants and bankers do around you, or what you might learn in business school classes, because the core principles are common sense. So you got the investment principle, the financing principle, the dividend principle. Now let's go back to the life cycle and let's think about where you're going to be most focused as a business, depending on where you're in the life cycle. So you've got investment, financing, and dividend decisions, right? You're a young startup. Which of these three decisions is going to have primacy in your company? What are you going to have to focus on more than any other? Of course, you got to raise the financing from primarily equity, but once you raise the financing, it's all about
Investing.
taking investments, right? It's all about investments, making great investments. Because really, you can't afford to borrow money, and dividends are way down the future. There's no financing and dividend policy to worry about. If you're ever offered a job as a CFO at a young startup, don't take it, because you know a CFO at a young startup is like the janitor. You're about at the same level. Nobody cares about you. Well, what are you going to do anyway, right? It's not like you're choosing the right mix of debt and equity. It's all about the product. It's built around technology teams and R&D and coming up with the product and making sure you make the right investments. You go through the life cycle, you go from startup to growth, you're building a business, and you get to a point where you're starting to make money. Cash flows start to come in, but something more negative also starts to happen. Your investments are no longer as good as they used to be. You become bigger. It's not as easy to find great investments. So your returns, which used to be 30, 40, 50% of your projects, start to drift down to 20, maybe 18, maybe 16%. Remember, when you're making 40% returns, do you care that your cost of capital is 15%? No, you're making such high returns. Who cares that you could lower your cost of capital by 1% by using more debt? You really don't care. But as your returns start to creep down, guess what you start to think about? Maybe I can lower my hurdle rate from 15 to 14% by doing this and this. Do you see how the focus is going to shift as you become a mature company towards a financing principle? At mature companies, the CFO has a great deal of power because the company rotates around finance. And then you go into decline. Forget about good projects now. So the investment principle is gone. There's nothing to fund. The financing principle is an afterthought. What's your focus in decline? It's to give the cash back to the owners. It's all on dividends. It's all about, sure, what should I sell? What should I divest? What do I get out of? Your focus in corporate finance is going to shift as you go through the life cycle. And as you go through the life cycle, your cash flows are going to reflect that focus, right? Early on, you're a money losing, high growth company. The money losing means you start with a negative number. What does high growth require? A lot of reinvestment. You got to build or spend in R&D on building factories. You take losses and you reinvest on top of that. What happens? Your cash flows are going to be negative. I've often heard VCs complain about cash burn at young companies. Cash burn is basically those negative cash flows. And my response is stop complaining. That's a feature, not a bug. At young companies, you should expect cash flows to be negative. So when you're valuing young companies and you look at their financials, what are you going to see? You're going to see a loss and you're going to see reinvestment. And it freaks people out because the only valuation models they've been taught in class all have nice positive cash flows to begin with. So what do I do? You got to live in the world you're in, not the world you wished you were in. This is a young growth company, its cash flows are going to be negative. But if it has true potential, what should happen? As it grows, first its losses should get smaller. Why is that again? What are the forces that in a healthy young company make losses smaller? One is economies of scale, right? Expenses grow, but they grow at a slower rate than revenues. The second is unit economics. What's unit economics? What do you make on that extra unit that you sell? In businesses where the unit economics are strong, as you grow, you're going to turn the corner much more quickly. I'll give you two contrasting examples. You can have a young startup automobile company, let's say it's an electric car company, and a young startup software company. Which one's going to turn the corner sooner and why, based on unit economics? One is a software company, the other is an electric car company. Which one will turn the corner sooner based on unit economics?
The automobile
That's the
one.
question
Software
you're
company.
asking. Yeah, go ahead. Somebody
I think
said
the
something. Why?
The software company.
Software company, sir.
Go ahead,
Software company.
Piyush. I can hear you now. What do you
Software
say?
company, sir.
What's the unit economics for a software company when they sell an extra unit of software? How much does it cost them to make that? So you go onto Microsoft, you order a copy of Office 365, or you add on and off. You think that some software engineer in Bangalore runs around trying to put together a copy of Office just for you?
No, sir.
It costs nothing, right? That extra revenue they get is all pure profit. So when a software company grows, each unit of software itself just pushes down into the bottom line. So they're going to, doesn't mean their cash flows will turn positive overnight, but they will turn the corner sooner if they're really growing. An electric car company, if they're growing and they sell another electric car, what do they have to do first before they sell you the car? They got to make the damn thing, right? And that costs money. You got the materials, the labor. A manufacturing company that is in young, high growth will turn the corners a little later than a software company, simply because unit economics and economies of scale. But if you're healthy, eventually the losses will become profits. But if you're growing, you might still have negative cash flows. Why is that? Because even though your profits are positive, what are you still doing? You're pumping money into the business, increasing capacity, building more factories. Your earnings will usually turn positive sooner than your cash flows will. But the cash flows too at some point in time will turn positive. You know when they'll turn positive? Is when your growth rate starts to decrease. People always complain about my growth is lower. There's actually a benefit to having lower growth, because with lower growth you reinvest less. If you reinvest less and you're making money, your cash flows turn positive. And when your cash flows turn positive, guess what also opens up? Your capacity to borrow money, your capacity to pay dividends. One way to detect where your company is in the life cycle is look at their earnings and cash flows. If their earnings are very mildly positive and the cash flows are big negative numbers, they're probably growing companies still. They're young companies. Doesn't make them great companies, doesn't make them bad companies. It's just a recognition of where you put the company in the life cycle. So here are the reality checks. The young companies, you're going to burn through cash. Stop complaining. This is the way you should expect. When you see a young startup claiming to have positive cash flows, my reaction is one part of the statement has to be a lie. You're either not a young growth company or your cash flows are not positive. You can't have both coexist. As businesses mature, cash flows will turn positive. You will be able to borrow money. And as companies mature, you should have more cash available to return to shareholders. That said, though, remember what I said about middle age, that nobody likes to be middle aged? So here we're saying as growth companies mature, their capacity to borrow money will show up, their capacity to pay dividends will increase, right? So growth companies become middle aged. So what do human beings who get middle aged who don't want to be middle aged do? They go to plastic surgeons, right? Make me young again. They hire a physical trainer because they want to be young again. Do companies do something similar when they get to be mature companies? They're in denial. They don't want to be mature companies. Everybody wants to be a growth company. So at least initially, when you become a mature company, guess what you do? You don't borrow money. You don't pay dividends, hoping that you go back to being a growth company. It took Intel 10 years after becoming a mature company to wake up and say, guys, we're not being a growth company anymore. And of course, they're aided and abetted by the plastic surgeons of the business universe. Who am I talking about? Who goes around telling companies they can be young again? What's a consultant's real job?
Consultants.
That's all
Management.
consultants do. You can be young again. Oh, by the way, here's what you need to do. Just pay us 50 million. We'll come up with a strategic plan to make you young again. When Walmart bought Flipkart, I
Yes.
described it as the most expensive facelift in history. Because you paid $21 billion for a business that had never figured out how to make money. But why did they do it? Because they felt old. What made them feel old? This company called Amazon that kept saying, hey, look how young we are. So as companies grow, you're going to see this. And I don't do consulting. I'm too lazy and opinionated. But if a company asks me for advice, my advice is singular. Just act your age. To me, more value is destroyed by companies refusing to act their age. Young companies borrowing money. Mature companies refusing to borrow money or pay dividends. Stable companies that go out to do acquisitions are just a sign that you're having a midlife crisis, right? Because what do you hope the acquisition will do? Get you back to growth. And declining companies that hire new managers and say, make us young again. Make us the next Apple. And remember, consulting firms are good at showing, look, you can be the next, next Microsoft. Microsoft was an aging company in 2013. When Satya Nadella came in, where did Microsoft make all of its money in 2013? Office and Windows, that's it. It looked like a company that was making a lot of money, but was obviously on its, if not declining phase, a very mature phase. And to give Satya credit, he found a way for Microsoft to be young again. By doing what? What's the business that Microsoft entered that gave them a new lease on life?
Cloud
First, it
computing.
was what?
Cloud.
Cloud through Azure. And the other was the subscription business. Initially through LinkedIn, but then they converted their software business. Today, I used to buy Office every 4 or 5 years to update. So that's the way their business used to operate. Today, 90% of Microsoft's revenues from Office come from what? Office 365 is subscription business. So can middle-aged companies be young again? Well, Microsoft, it worked, right?
Yes.
Apple, it worked. Steve Jobs in his second coming came back with the, because remember in 2000, Apple was a dying company. Macs were going, who was buying a Mac other than me? Now do you see why Apple and Microsoft are so dangerous because they're used as examples for every company. You can be young again. Look, Apple. The reality is for every Apple and Microsoft, there are 500 companies that try to be Apple and Microsoft. And guess what happens? They crash and burn. They crash and burn. They burn through tens of billions of dollars trying to be young again. So that's the corporate finance part. And you can already see how you approach a company, what you focus on is going to vary depending on where you're in the life cycle. Let's talk about valuation. You guys can't even see my slides, right? I
No,
should be
sir.
sharing my slides. Let me share my slides.
Sir, we have also collected a couple of questions.
Let's see. I want to just share. I don't see a slide sharing option here.
Sir, there would be a share option just beside the camera and mic.
I'm sorry, what? By the
Sir,
mic?
just yes, sir. Just near the camera and mic option, there would be share option.
Oh, there you go. You guys see my slide?
Yes, sir. It is visible.
Okay. Okay. So let me talk a little bit about how valuation changes depending on where you are in the life cycle. When I've taught valuation now for almost 40 years, and one of the things that's troubled me about how valuation has evolved over this time is it's become all Excel spreadsheets, Excel ninjas. It's become modeling. Financial modeling has become valuation. You know how many spreadsheets I open in my valuation class? In 26 sessions, 15 weeks, I must open hundreds of spreadsheets, right? Zero. I've never opened a spreadsheet in my class because opening a spreadsheet, going line item by line item, is teaching you Excel. Why are you wasting your time in a valuation class if you want to learn Excel? But investment banks really don't do valuation, they do financial modeling. So I'm going to give you my perspective on how to think about value. To me, a good valuation is a bridge between stories and numbers. You see, what are you talking about? Every valuation, if you show me the valuation, you point to a number and say, why is that number what it is? You need to tell me a story that backs up the number. In every story you tell me about the company, I need to be able to point to a number in the valuation and say, that's the number that goes with it. And I think one of the problems we face in valuation is you have numbers people, bankers who can work with Excel spreadsheets but don't understand stories. You have story people, founders, VCs who can't work with numbers. And it's like two different tribes speaking two different languages. So my valuation class is often about, hey, how do you come up with a narrative for a company that reflects the reality the company faces, the business it's in, the competition, and how do you convert that story into valuation? But this balance between story and numbers shifts depending on where you are in the life cycle. If you're a very young company, guess what matters when you value the company? And I valued Zomato or Paytm. It had to be story, right? The numbers are not there. There's nothing to build on. You can't build a financial model for a young company because there's nothing there. It's the story that drives the valuation. Can't be a fairy tale. I still have to constrain the story. So if you take a look at my Zomato valuation, I'm very intent on telling you the story for Zomato. And if you remember, the story I told for Zomato was as much a story about the company as it was a story about India. And here's why. How does Zomato make its money? By delivering food from restaurants, right? And to deliver food from restaurants, what do people have to do? They have to eat at restaurants. They have to order from restaurants. Now, do you know the leading food delivery market in the world? What's the biggest food delivery market in the world? Does anybody know? It's China. It's 3 times larger than the US, which is the second largest. Then you have Europe, and then you have India. So the first thing was, if India is a small market, Zomato is a dominant player in this market. But if the market stays small, there's not going to be much growth. You see why, right? They have almost a 40% market share. So the market stays small, they can't grow much more than the market itself is growing. So the story I told was about, hey, how do I think this market will evolve? Now, why do Indians spend so much less at restaurants than Americans? Let's start with the easy one. Why do they spend less than Americans? Because they can't
Low per
afford it,
capita
right?
Per
income.
capita
Low per
income
No,
is
capita
I would
income.
less.
say 80% of Indians are no, I mean, they have a tough enough time getting enough food to put on a pot in the, it's not like they can, you're not in a village, but picking up phone and say, babe, bring me biryani from, the restaurant. It's not a choice you have. So the first thing that's holding Indians back is the fact that, I mean, India is more prosperous than it used to be, but it's still less prosperous than China or the US. The second is to be able to do online food delivery. What do you need? You need a smartphone, and which is better in India than it used to be. And you know what? Half of Zomato's value should probably go to Geo, for the simple reason that Geo has changed the smartphone business. I mean, I tell the world, Paytm and Zomato owe a great deal of the value, because without Geo expanding the market for the smartphone, how the hell are you going to get on Paytm and do all the neat stuff you want to do? So the second thing that holds Indian banks still is smartphone, even though it's grown, is still not as universal as it is in the US or in China. The US is maximum, then China is below, but India is way below. And there's a third reason, which is cultural. The Chinese have always eaten out. It's a part of their culture, gathering in restaurants. Eating at restaurants, at least in many parts of India, was not part of Indian culture. And I gave the anecdote of growing up in Chennai, which when I grew up in Chennai, it was a big city already, but it had, I think, 5 restaurants for the whole city. You had this place called Woodlands. You could go order dosa and whatever, but there weren't that. You're saying, how come? Because the people who are well-to-do in Chennai, when I grew up, did not go to restaurants. I remember my grandmother saying, why would you go to a restaurant when you can tell the cook to make exactly what you want at home and you know what the ingredients are? She didn't trust restaurants. She never ate out. She lived to be 83. She never once ate out in India at a restaurant. So to tell a story about Zomato, you got to tell a story about how India's economy will evolve, because it's got to get more prosperous. And as it gets more prosperous, presumably restaurants will get better. But also a story about how cultural mores are shifting. I'll wager that Indians today are more likely to order from a restaurant than they were 30 years ago, simply because it's become more of the done thing. Chennai now, we have, I think, at least 1 million young people who come into the city to work, who live by themselves and work all day. They're not cooking food for themselves, they're ordering food delivery. So my story for Zomato reflected what I think would happen in the market. It was also a story about who will dominate the market. Will Zomato stay on as a market leader? So my valuation of Zomato was driven more by my story for Zomato than it was driven by looking at the financials or looking at what forecast experts were making. I had no choice. In contrast, my valuation of Asian Paints, and I have a valuation somewhere out there of Asian Paints, I didn't need much of a story, right? It's a company that's been around, very successful. You can see its track record, you can see its growth, you can see its margins. Same thing with Tata Motors, ITC. The numbers will drive you. Doesn't mean there's not a story, but the numbers guide the story rather than the other way around. So what you focus on will be different depending on a company. And with young companies, you have no choice but to build a story first. And if you're not comfortable telling stories, guess what's going to happen? You're going to give up on valuing young companies because you're so used to having a lot of financials that you can focus on. What do I do? Most bankers refuse to value young companies. I've heard bankers say, why would you bother valuing Zomato? And I said, what do you mean? He said, there's too much uncertainty. I said, what exactly do you plan to do with all that uncertainty? Not telling a story, it doesn't make the uncertainty go away. It's a classic excuse that venture capitalists and bankers make for not valuing young companies so that they could do whatever they want. So if you're a natural number cruncher, get comfortable with the storytelling part of business. This is not telling fairy tales, but telling business stories, because that's a skill set you need when you value young companies. It's your financial models and Excel ninja skills will work when you get to mature companies. But if those are the only companies you want to value, you can be a banker and you can pull out those Excel spreadsheets, but they're not going to help you value the Zomatos and the Paytms of the world. So when you think about young companies, stories are central. They're central. They drive your valuation. They're also going to be divergent, which means your story for Zomato is going to be very different from mine. Why? Because we're looking at a young company. We're trying to decide where it's going to go. Of course, we're going to disagree. And they're going to be volatile, which means that events can very quickly shift stories. You know what I mean by events, right? If you look at Paytm, a government action that says you can't do transactions online on these businesses could very quickly put an end to your story. As companies age and the numbers, the narratives become less critical, they go to the background. So I'll give you an example of my Zomato valuation. And this was at the time of their IPO. You remember this is a widely publicized IPO. Everybody's talking about is a coming of age for India. Look, young money losing companies can now go public in India. And it's true, they did go public. Their original offering price was set at, I think, 72 rupees, and then it opened up 90 rupees, 130, 150. But this was my original IPO valuation. And I said, look, this is my story and my value for Zomato, because there was a lot of pushback saying, no, I don't like your growth rate. Fine, use your own growth rate. My spreadsheets are always open spreadsheets for that reason. I'm not saying my story has to be your story, but my decisions have to be driven by my story. But every number in this valuation reflects a story I'm telling about the company. So you see, I start with the total market, where I'm telling a story about India and food delivery in India, a market share assumption, which is driven by what I see about the type of business and who's going to dominate the business, margins for the business that reflect the fact that Zomato is an intermediary, right? They just connect buyers to sellers, which means their margin should be high in steady state because they don't have to make things. There's no production line. Every number in this valuation reflects my story for Zomato. You can see the original valuation I came up with was about 40 rupees. And over the next few months, I heard from people saying, are you sorry about the value? No, look, the number is at 130 now. And I said, look, it's not my job to explain what the market is doing. It just doesn't make sense for me. But as part of my original valuation, I also accepted the fact that I could be wrong. In fact, what I did in my original Zomato valuation, you can see it in the blog post, is I looked at potential stories you can tell for Zomato and what the value per share would be under each of these stories. So you look at the last column, you can see that I could potentially tell a story of a delivery juggernaut that delivers not just food, but groceries and all kinds of stuff, and the stock could be worth 150 rupees. I think there are very low odds on the story working, but you could tell that story. These are all plausible stories, but they're not all probable stories. I'm a big fan of the words possible, plausible, and probable. Possible means it can happen. Plausible means I could tell you a story about how it could happen. Probable means I think it's likely to happen. Some of these stories are just plausible, but they're not probable. Now, as companies get older, they get bounded. Let's get to the other end of the spectrum. You got ITC. ITC, in spite of all of the other stuff it does, still gets at the core of its value from a product that is aging in terms of its demand, and which is, without Charminar, you've taken the heart out of ITC. It still lives off the cash flows from its tobacco business. Now, of course, they could have stayed a tobacco company. One pathway ITC could have followed is said, look, we're just going to be a cigarette company. The bad news is you're not going to grow fast because even in India, growth is starting to level off because people are finally getting the message. This is not good for you. It can cause cancer. Younger people are steering away from it. So the bad news if you're a tobacco company, and there are lots of companies in the world that say tobacco company, like Philip Morris, is you don't grow very fast. In fact, Philip Morris has a growth rate now, a revenue growth rate of like 0%, minus 2%. You know what the good news though is? It's an incredibly profitable business. Philip Morris has the highest profit margins of any company in the S&P 500. Its margins are 57%. Those cigarettes you buy cost almost nothing to make. Same thing's true for ITC. Its cigarette business is incredibly profitable, but it's low growth. But about 20 years ago, ITC decided that they wanted to be more. In fact, more than 20 years ago. They didn't want to be a declining, shrinking business. So what did they do? They started going into other businesses. Like what? Like consumer products, like hotels. I've never understood why you would want to enter the hotel business. Remember, we talked about bad businesses. The hotel business is a bad business, a business with terrible margins, huge costs, big infrastructure spending. But you know why companies like to be in the luxury hotel business? If you're a manager of a company, being in the luxury hotel business means you have a nice place to stay no matter where you go in India. There's an ITC hotel there, and you're an ITC manager. And from an ego perspective, look how great it is. Look at the ITC Chola. Look at this land. Look at this monument we've built to ourselves. You live in the world we're in. So I valued ITC as a cigarette company with these other businesses that require a lot of care and attention. But essentially here, I have the numbers to back it up because this is a company much later in the life cycle. I still have to tell a story, but the story is bounded by what the numbers tell me. And finally, I'm going to give you an example of a company that actually faces up to where it's in the life cycle. It's a company called Severstal. It's a Russian steel company. And Russian steel, it's obviously been delisted with all the problems in the last year and a half. But it used to be one of my favorite companies to talk about, and I still talk about it, because at the time that I valued Severstal, this was a valuation I did actually for a valuation class I did in Moscow, its revenues had dropped by about 50% in the 5 years leading into the valuation. Now, if I told you revenues have shrunk by 50% at a company, what's your first reaction about the company? Must be a bad company, terrible things are happening. No, this was actually deliberate. They actually shrunk their revenues deliberately. Saying, why would you do that? Because the steel business had become a bad business. You know what made the steel business become a bad business? Chinese steel companies were producing steel and selling them at prices that you couldn't compete with in Europe, in US, in China. And steel companies around the world were seeing their margins converge on 3, 4, 5%, and they were not able to earn enough returns to justify their cost of capital. Now, what did we say? What did we say you should do if you're in a business where you cannot earn your cost of capital? Become smaller, right? There's only one company, one steel company that took that advice and was Severstal. They said, this is a bad business. We're going to shrink and sell off our European operations, our US operations, our Asian operations, but keep our Russian operations. You know what's so special about the Russian business? Severstal had insanely high competitive advantages. Chinese companies couldn't come in, European companies couldn't come in. And guess what margin Severstal made on its Russian business? Almost 20%. Remember I said it was 3, 4% for the. So what they've done is actually shrink as a company, go back to their core market where they were profitable. They were a much smaller company, but a much more profitable company. And my valuation reflects it's not a big booming story of 20% growth and margins improving. It's a story of constrained growth because that made the most sense for the company. There are many companies that would be worth more if they grew slower. than at the rate they are now. If they were less ambitious in trying to do things. And that's what your job in valuation is, to reflect what companies do. So here's the bottom line on valuation. To value young companies, no matter with startups, young growth companies, you need to be a good storyteller. You need to understand business. You know how you learn to understand business? Go work at a business, or go work at the local tea stand. It's great practice on learning to deal with costs and revenues, because otherwise you sit around with a spreadsheet and you do stupid things like make the growth rate go to 30% from 10%. Anybody who's worked in a business knows that to grow faster, you either have to cut prices or you have to spend a lot more on marketing. You just don't change the growth rate in a spreadsheet and expect nothing else to change. If you deal with mature businesses, you can get away with being a number crunch, an Excel ninja, because there the stories matter less. Which brings me to the final piece of what I want to talk about. Remember the start of this class, somebody raised the point about being bankers for startups, where they were doing valuations for startups. And I pretty abruptly jumped in and said, you don't do valuations, you do pricing. Let me explain the difference. We use two words in business interchangeably, value and price, which we should. Value, we know, is driven by cash flows, growth, and risk. And cash and price is driven by demand and supply. See, Baron, demand and supply affected by cash flows, growth, and risk, yes. But you know what else affects them? Mood, momentum. Hey, what made Zomato's price go from 72 to 150? Wasn't something fundamental changing in the company, right? But traders' mood about the company was good enough that it kept pushing up the price. Don't try to explain what happens to market prices using fundamentals, because most of the time, it's got nothing to do with fundamentals. It's mood and momentum. You see where I'm going, right? The pricing process and the value process can deliver different numbers. You can't get frustrated about that and say people are being crazy. It is always the case that the two processes deliver different numbers. Over time, the two might converge, but that requires faith. But price and value are different. Remember what I said about young companies, that people don't like to value young companies. Why? Because they don't like to tell business stories. They claim it's too fuzzy, too uncertain. So how do VCs put a number on a company? How do they put a number on a Paytm, a Zomato, or any other young company? What do? They price them. Based on what? Some common metric. To price something, you need to scale it to something else, right? And if you have a young company which is losing money, you can't scale it to earnings, so you can't use a PE ratio. You could try revenues, but if it's a pre-revenue company, even that's tricky. So guess what you're left with to scale it to? How many users do you have? How many downloads did you get? Pricing, you scale to something, and you see pricing actually used much more with young companies because people think that they cannot. I believe they're wrong. I think they should try. I think the problem with Paytm is there's been too much pricing. You know why they focus on users? Because through their entire life as a company, they've been rewarded for having more users. It's only in the last 2 years that the worm has turned. But until then, here's all they did. They went and said, we have 50 million more users. Oh my God, that's amazing. Let me push up your pricing a little bit more. But when you look at companies, you see the focus more on pricing than on value. And the pricing will be based on metrics like users, downloads, subscribers. Why? Because you often have no choice. Let's be clear. When you're focusing on those things, you're doing it because of desperation. Because the numbers are not there. As the numbers first start to show up, you start to see revenue multiples being used. Why? Because the earnings and the cash flows might still be, but now you have revenues to point out. What are the revenue multiples? And as you mature as a company and you start to get earnings, then you start to see earnings multiples, price earnings ratios, EV. So when you look at pricing across the life cycle, you see the metrics start to shift as you go through the life cycle. And then you get into decline, you'll see book value come into play. Why? Because there's at least this perception that book value must be close to liquidation value, that if you try to, it might be completely false, but you're going to see not only different metrics scale through, but what effectively you're going to focus on is going to shift. as you look at companies across the life cycle. Which brings me to the final piece of what I want to say. I'm often asked what makes for a great CEO. You know, there are two institutions which effectively made it their mission to kind of talk about what makes a great CEO. You know, the two institutions are? One is the Harvard Business School, which is the home of all bullshit. It emanates from the school, it gets sent off to consulting firms who make millions of dollars in it. But the Harvard Business Review, at least every year or two, runs this article on what are the characteristics of a great CEO. They'll go through this and this and this and this. And the other institution that promotes this notion that there is a great CEO is McKinsey. McKinsey, they have a magazine called McKinsey Quarterly. They'll talk about, here are the characteristics. And you can see why it's self-serving. Why does Harvard Business School keep talking about great CEOs? What's the message they're sending you? If you come to a Harvard Business School and you get your MBA, we'll teach you the characteristics. I described every Harvard MBA as a CEO in waiting. They just don't want to go through this. They want to be a CEO right away, but Harvard Business School will teach you. And why does McKinsey talk about great CEOs? Because if you bring McKinsey in, they will teach you how to be a great CEO. I tell you up front that what both Harvard Business School and McKinsey are selling you is a bill of goods. There's no such thing as a great CEO for every company because it depends on where you are in the life cycle. If you're a young company, what did I say drives your value? It's not the numbers, it's not the Excel spreadsheet, it's your story, right? So you know what you need as a CEO of a young company? You need a visionary, a storyteller, somebody charismatic who can attract money to a story, attract employees to a company, attract customers to a product. You need visionaries, you need storytellers. But to convert that story into a business, you need pragmatic people, people who can build businesses. The skill set is different, right? And as you become a mature company, what's your primary role? It's to protect the company from competition. You need somebody who's defensive, who can play defense. If you ask me to describe the perfect CEO for a company, and I'm at the risk of, kind of being sexist and, give you the different, for the young company, you need Steve the visionary, somebody who can tell a great story. For young growth companies, you need a pragmatist, Paula the pragmatist, who can build, who can stay consistent with the story. High growth, you need somebody who builds a business. Sales about supply chains. You need Bob the builder. In mature growth, you need somebody who's opportunistic, who says that market looks underserved, let's produce a product. In mature stable companies, you need somebody who can play defense. And in declining companies, you need Larry the liquidator, somebody who's willing to say, look, I have no ego, no ambition, I don't want to get bigger, I just want to make money. Can the same person be all of these? Perhaps, but it's very unlikely, right? Now do you see why somebody can be a great CEO for a company at one stage in the life cycle, but not be the right CEO for the next stage? And here's the problem you're going to run into. Because as the emphasis shifts, the types of skill sets you want in your CEO also need to shift. The person who's the right CEO for you, for your company, will be very different when you're a mature company, when you're a growth company. I draw the contrast between the classic 20th century company and the 21st century company. I'll give you a classic 20th century company, GE, Ford. When was Ford founded? I think 1900, maybe 1898. It's still around, right? 126 years later. Who was the first CEO of Ford? Does anybody know? This guy called Henry Ford. Eccentric visionary. Why eccentric? Do you know that the car that he produced that made cars mass market products was called the Model T? Does anybody know what color it came in?
Black.
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 Black, that's it. You know why? Because Henry Ford said, who would want to drive a car that's in any color other than black? That's eccentric. But he
Yes.
was the right CEO for the company because he converted the car from a luxury product that only the very, very, very rich had to something that average people could own. Perfect CEO for the company, a visionary, charismatic man in terms of attracting people to the company. By 1930 or 35, Ford was now no longer a young startup, it was an established company. And Henry Ford was actually becoming a little bit of a problem. So for those of you who've read the history of Henry Ford, he became a bit of a Nazi. I don't know whether you can become a bit of a Nazi, but he became a bit of a Nazi in the 1930s. He said he had some really strange ideas. He could have dragged Ford down with him, but you know what saved Ford? Mortality. Henry Ford had a heart attack, he died, and then a new CEO came in, young blood, different views, and the right person for the company. The classic 20th century company, time took care of transitions. Your CEO would just become older and get replaced. Classic 21st century company, to me, is Yahoo. Founded in 1992 by two Yahoos from Stanford, two guys who call themselves the Yahoos, hence the name Yahoo. By 1999, it was a $100 billion company, from nothing to $100 billion. Glory days lasted 5 years till Google came along and the company went into decline. By 2015, the company was done. 23 years from start to finish. Do you see the problem we're going to have with 21st century companies? The people who take the company, who create the company, who take the company public, might be the right people for the company then. Great founders. But if the company shifts under them, they could very quickly become liabilities. It happened at BlackBerry, right? Those two Canadian guys, I forget their names, who started the company, were viewed as geniuses when they made BlackBerry the kind of growth company, the standard technology. But they were viewed as dunces in the 10 years after because they couldn't adapt to the fact that BlackBerry was now being disrupted by Apple. We're going to have a problem in the 21st century of young companies where founders have outlived the value. Let me ask you a question. 5 years ago, did anybody have any questions about Mark Zuckerberg being CEO of Facebook? No, right? The company was succeeding. Everybody thought he was a visionary genius, a little strange, but visionary techie. Today, there are questions about, is Mark Zuckerberg the right person at Facebook? Tesla, 3 years ago, if you ask me, well, if you ask most Tesla investors, what do you think of Elon Musk? Amazing guy, he adds value to the company. Today, there are questions about, hey, is Musk more liability or asset in terms of, in terms of Tesla? We're going to have more clashes between CEOs and investors. The problem, those we've handicapped ourselves at companies like Facebook as shareholders by doing what? By allowing for voting and non-voting shares. Zuckerberg controls the company with 14% of the shares. He controls 57% of the voting rights. But we're going to see this play out as life cycles shorten. You're going to see more clashes between investors and managers, and more difficulty getting managers out of place because of the way we've structured voting rights. So I'm going to close with a saying that I think applies to both human beings and companies. Growing old is mandatory. Everybody grows old. I don't care who you are as a company, how great you are, you will get old. Growing up is optional. As managers, you got to decide whether you want to grow up as companies, act in a way that befits your age, or run the risk of your companies essentially crashing and burning. That's pretty much it. I'm going to stop sharing. So let's see if I can stop the sharing. Let's stop share with somewhere over here.
So by clicking the same option, share button.
Okay.
Thank you, sir, for such an insightful presentation. We know that the time has already exceeded, but if you are free, we would like to discuss
I
few
have about 10
questions.
minutes if you have questions. I have another call in about 25, but I've,
Yes, sir. So we have collected some questions from the audience earlier.
Okay.
So first one is how to value giant companies like Alibaba, Tencent, etc., which is available at a somewhat
Let me ask
discount
you a question.
today, but
Forget
there
so
is
giant
geopolitical risk.
so let's focus in. So when you say giant companies, so big companies as opposed to small companies, what is it about? So whenever you have a question about a particular company or a particular sector, focus in on what it is about that company that troubles you. So what is it about giant companies that should make them, all it is three more zeros, right? So by itself, what is it about big companies that you find difficult to bring into valuation?
So, like in this case, there is a geopolitical risk
Okay, so
associated,
be clear
and
about this. Is nothing to do with giant companies. You're asking about Chinese companies. Be clear about, see, giant companies, I thought you were going to say it because they're in many geographies, they're in many businesses. That's one kind of challenge, right? If you're so you can bring that in. If your question is about Chinese companies, this has nothing to do with giant. I would say the same thing would apply if you're looking at a DD or a small Chinese company. What is it that worries you when you value a Chinese company? I told you every valuation you're telling a story, right? When you value a Chinese company, who's a character in your story, even though you might not want them there? Who's a player in your story?
The Chinese
Beijing.
government.
The Beijing is in the room with you, right? You're saying, so what? Much as we like to look away, the fate of every Chinese company is in the hands of Beijing. You saw that with Alibaba, right? Jack Ma was a hero 10 years ago. Now Jack Ma is persona non grata. I've heard stories that he can't even go back into China. The problem with Chinese companies has always been that the story you tell, the government is part of that story. And to the extent that the government is part of that story, it can make your company, it can break your company. You got to bring it into the story. For the longest time, what helped Alibaba and Tencent? The government was part of the story, but what do we view the government as? An ally. We said that the government will be on Didi's side to keep Uber away. There will be on Alibaba's side if Amazon tries to come in. And we pushed up the values of these companies because that was as recent as 2018 or 19. We viewed the government as an ally. What changed? Why did the government go from being an ally for these companies to a potential enemy? What does Beijing value more than any other component? What does it value? It does want economic growth, it wants prosperity, but what does the Beijing value the most?
International
Con-
reputation.
Control.
Positional.
Control, right? And their concern was that Tencent and Alibaba were taking control away from Beijing because WeChat, if you think about much of China is covered, you think about what you can say and not say. So they were concerned that these companies were getting so big that they were threatening Beijing's power. It's almost magical seeing that shift from going from ally all of a sudden overnight to enemies. And if you thought that Alibaba was too big to stop, look at how quickly Beijing has brought Alibaba back to its knees, right? Saying, look, they've managed to get Jack Ma out of the picture. The company now is run by, remember, Alibaba is a publicly traded company, but what's traded in the US is actually a shell company based in the Cayman Islands. The actual operating company in China is run by 19 people in Hong Kong who used to be picked by Jack Ma. And guess who picks them now? The
Beijing.
Chinese government is a much bigger role in them. So it's become almost a government-run company with restrictions on what it can do. And that's, I think, so when you value the company, that's got to become part of your story. I think margins are going to decrease because they will be required to do this, this, and this as part of, like every other government company, they're going to have things that are going to be asked to do, which are not in the economic best interest of shareholders. Guess what? They don't have the option of saying no. So I'm not trying to pick on you when I said what's with big companies or small companies or steel companies or infrastructure companies, focus in on what it is about a company that gives you trouble, because that'll allow you to come up with solutions. The solution for a company where the government is part of the story is to bring it into your story and perhaps value the company with the government as your ally and with the government as your enemy, and then think of it like a decision tree, my expected value. I mean, do you think you can value the Adani Group without bringing in some talk of, I mean, I'm not saying again, it's neither good nor bad. It is part of the story of the group, right? That it has connections that can help it grow faster than would have otherwise, which means you can't value the company without taking a political component to your story, right? Who wins the next national election could have a big effect on your value. You can't just say, I'm going to ignore it because it's not realistic. You might want to value the company assuming the BJP wins the next election. I mean, value the company, the BJP losing the next election. You might attach only a low probability to the second number, but you can't ignore it. So what you worry about will differ across companies. So don't think of it as big companies or small companies. Focus in on what it is about a company that troubles you and then say, how would I solve the problem? Look into your toolkit.
So our next question was on the Adani Group companies, which you already covered in the answer of the first question. So what is your biggest valuation analysis mistake till now and the learning associated from it?
Oh, I make mistakes all the time. It doesn't biggest will be the one that I put the most money in. Biggest is not in terms of the biggest company you screw up on. It's the biggest personal mistake that follows from it. So I've lost money on companies. I didn't, and I wasn't able to trade Paytm, but obviously I priced Paytm, I valued Paytm at 2,000 rupees when it went public. It's trading at what, 600 rupees now? So I'm not ready to give up on it, but at the same time, I severely underestimated the capacity of this management to run a business, or overestimated, because I don't think this management has has the capacity to run a business. Until you change the management of the company, I don't see a way out. Because as I said, they're great at adding users. They can't figure out how to make money. And I should have had a clue, because when these guys who founded Paytm got on TV, there was no focus to what they were saying. They weren't talking about how they were planning to monetize users. They kept talking about number of users. They talked about how they're going to revolutionize Indian payment processes. Sometimes that's a dead giveaway that you haven't thought about the business model itself. Because if you think about Paytm, it's an extension of an age-old business model, right? It's a credit card business. It's like a credit card business. How do credit card companies make money? MasterCard, Visa, American Express. It's based on take rates. Take rates are the percentage of transaction values that happen on your platform that you get to keep. You know what the take rate is for Visa and MasterCard? It's about 2 to 3%. PayPal is about 2.5%. American Express is about 4%, which is one reason merchants don't like to take American Express. So every time you pay with the Visa card, 2.5 to 3% of whatever you pay goes to Visa or MasterCard. That's called the take rate. That's their business model. So their value comes from the fact that a lot of transactions happen on their platforms, and they get to keep 2.5 to 3%. PayPal has 350 million users. That's its plus. It's the advantage that Indian and Chinese companies often have is when you talk about numbers of users and subscribers for Indian companies, it's always going to be impressive, right? You know why? You have 1 billion+ people, you're going to get to 300. No European company can ever have 350 million subscribers because there aren't 350 million people on all of Europe put together. So the first reaction that people have to PayPal is, this is amazing. You have 350 million users. They're doing transactions on the PayPal platform. But you know what PayPal's take rate was at the time they went public? 0.7%. Which means they're not collecting much. So first, there are not that many transactions, and in my original valuation, I estimated that take rate would improve to about 1.5%. I don't think they're ever going to approach Visa and MasterCard because you have the UPI effect. You know the UPI effect is, right? In India, at least, there is this capacity to do things for free online. It becomes difficult, therefore, to charge the kind of hefty take rates that PayPal does. You know what the take rate for PayPal is now? I'm sorry, Paytm is now, right? 2.5 years later, it's still 0.7%. It's almost like they haven't learned anything over the last 2.5 years. So in terms of mistakes, I make plenty, and some of the mistakes are macro mistakes. Some are mistakes, but to me, the definition of a mistake is something you could have foreseen at the time of the valuation. So I valued a hotel company in 2019. I don't view it as a mistake that I didn't foresee COVID coming in 2020. So don't mistake the fact that sometimes you can do everything right and in hindsight be wrong for no fault of your own because the world has moved in ways that you didn't expect. So you got to be careful to separate mistakes from changes in the underlying economics because you don't want to make corrections to things you shouldn't be correcting. You shouldn't be changing the way you do things because something that was not in your control.
So one question we got in the chat section that what are your views about developing economies valuation like India versus the US tax
Back up
structure
again.
best by?
Right? What is different about valuing in, I mean, is it still cash flows, growth, and risk? Yeah. So what's different about an emerging market company as opposed to developed market company? Why might you face more challenges estimating cash flows, growth, and risk for an emerging market company? Because the economy itself becomes part of your story, right? In a mature economy, the US can go into recession, come into recovery, but it's not a question of will you grow at 10% versus 3%. In an emerging market company, you're making a joint bet on the company and the country. Let's face it, if India can grow at 10% a year for the next 10 years, let's suppose India now steps into the role that China had, they can grow at 10%. Every one of your Indian companies is going to go up in value more than you anticipated, right? Because in a sense, it's in a rising tide lifts all boats. So when you're working with emerging market companies, my focus is still exactly the same. I still care about cash flows, growth, and risk, but I now have to think about country risk and country growth as part of my story. Country risk, I bring into my discount rates. That's why I care about country risk premiums. And country growth becomes part of the growth of your company. So when I say a Turkish company will grow at 15% a year, whether I like it or not, I'm making an implicit assumption about the Turkish economy that I've got to monitor and make sure that I'm not getting wrong. Don't rewrite the rule books just because you have a Indonesian company or a Nigerian company. The rule books are exactly the same. The estimation challenges can be different.
One last question from us. You can unmute yourself and ask, and then we will wrap this session.
Yeah, thank
So,
Um,
you.
sir, my question is how to
go ahead.
put a story into numbers. How can one tell this company is gonna grow at a rate of 20 to 30% with a story in mind?
I'm sorry, with what in mind? With story in mind? I'm
Sir,
not sure.
as you have
Don't you do it all the
suggested,
time? I mean, how do you make estimates for the future? What do you base it on? You base it on what you know about the company, the market, the sector. Are you asking me what, now how do you know
so
you're right? Because what choice do you have? You have to make estimates, right? How do the founders come up with estimates? I don't see this as a particularly unique challenge. It's always an issue. If you ask me, how do I know whether I've got that number right? The answer is you don't. In fact, I'll guarantee you, you're going to be wrong every single time. But you know what the test you got to run is? Are you consistently wrong in one direction? Because if you're consistently wrong in one direction, you have a problem. You have bias. Mistakes you can live with. The essence of mistakes is sometimes you overestimate growth, sometimes you underestimate growth. But you consistently find yourself overestimating growth on company after company. Your problem is you're being biased. And if you're being biased, nothing you learn about valuation is going to bail you out. So make your best judgment given the data that you have at the point of time that you're doing the valuation. Don't beat yourself up after that because that's all you can do. Shivam?
Can sorry,
Anish,
Madhu,
go.
can I ask my question, please? I'm just uh, on clouds right now to be present in front of sir and ask my question, please. Can I ask my question?
Yeah, go ahead.
Yeah, sir. So Blackstone Incorporation is currently valued at over $100 billion. but it has assets worth $880 billion, and it has been termed to be actually controlling the world. So do you think while valuing
No, wait. We're talking about Black Rock?
no, no, sir, I'm talking about Blackstone
The
Incorporation.
private equity house, but it doesn't own 880 million. You mean the company's controls are worth 880 million? It's only the equity portion. That's like you owning buildings and you borrowed 90% of each building. If I add up the values of all the buildings you own, will it be far more than what you're worth? Of course, right? You cannot compare the value of the businesses a company owns to the market value of its equity. Because if you're in the business of leveraged acquisitions, guess what the equity is going to be? A fraction of the value of the buildings. A real estate developer is going to be worth a fraction of the values of the buildings he owns because he owes money on each of the buildings. So don't compare what Blackstone is being the market cap with the values of the companies it controls, because you're comparing apples and oranges, right?
Okay, thank you, sir.
Okay.
Professor, one
Yeah.
question. How much do you consider what a company is saying? So, if someone is saying that we are going to take the market leader
I will
position in
listen, but I'm not going to let it. See, look, my job is not to value the company with a management story, right?
Okay.
Because I mean, let's be real. If you let managers guide your story, are you going to end up with an overvaluation or an undervaluation? Almost always going to end up with an over. They're going to tell the story. That's not because they're liars or they're bad people. It's because they're telling a story that matches their interests. But it's my money that I'm investing. I have to listen to the story and say, I agree with that part of the story, but I don't think they can pull that off. So I will take the pieces of the management story that I think make sense because there's information there. But I've got to frame my own story. I can't value Zomato using Zomato's So Zomato's management come and say, we'll control the grocery business. My reaction is, one, you're not going to do it. Second, it's a much lower margin business than your food delivery business. So you can't allow me to use a 20% margin on the grocery business because you're not going to get that. So I will take the pieces of their story that make sense, abandon the pieces that don't, but ultimately I have to take ownership of my decisions, and that requires me to come up with my own story. So I'm valuing Tesla right now for my latest valuation. I'm listening to what Tesla's management is saying. I'm listening to what Musk is saying. I'm listening to what other people think about the company, but ultimately it's my money. I've got to tell my story for Tesla and be able to live with that story. And that frees me from having to be trapped. So that's why when people use management forecasts, my question is, why are you wasting your time? You're just, you're just an Excel number cruncher, right? They feed you the numbers, you put in an Excel spreadsheet. How is this evaluation? I see bankers and appraisers do this all the time. Where do you get the numbers? I got them from management forecast. So what exactly are you, a lackey that feeds numbers into a spreadsheet? That's not my job. My job is to tell my own story, my own valuation. That requires sometimes telling managers, I don't believe you. Suryansh?
Yes, sir. I wanted to ask that when, as you are defining a company's age, you said that with
No,
the
you don't have to
declining
define
negative.
a company's age, right? The age is what it is. So corporate age is when were you founded, where are you now? So actually measuring the age in chronological time is a fact. So you can say Microsoft is 38 years old from founding to today. Figuring out where it falls in the life cycle, I said you can look at the earnings, you can look at the cash flows, you can look at what the company is doing to make your judgment. Because there is young companies behave in a certain way. They throw off a certain amount of financials, and you should expect to see that. So if you have low revenue growth, your margins are positive, you're reinvesting very little, don't tell me you're a young company. It doesn't make sense.
Yeah,
You're
but
not, nothing you're
if there
doing
is
is,
a
yeah.
yeah, but there is a continuous negative flow rate. I mean, it could be declining, but still, there company is not getting into a
I didn't
positive
tell you
cash
young
flow.
companies were worth a lot, right? Can young companies be worth nothing? Absolutely. I didn't say that just because you classified a company as a young company, you should give it value. I just said it's a young company. You still have to make a judgment. Is this a young company which is going to turn the corner? Or is this a young company that's going to burn through cash and go out of business? I would still leave that choice up to you. So just because I've classified a company as a young company doesn't mean I'm going to attach a high value and give it the growth and the so that judgment will still depend on. I've valued young companies where I've looked at their business model and I've said, this business model is never going to make money. I'll give you an example. You've heard of Lime. Lime is this company that allows people to rent scooters. I think it was, so many cities in the U.S. You could visit the city. You could, with an app, you can unlock a scooter, then rent it by the hour and return it back. And I remember when this business got started, venture capital was very excited about it because it was growing fast. I looked at the business model and I said, I don't see how this business is ever going to make money. The unit economics are not there. The economies of scale are not there. I don't see how they can make money. I gave them growth, but I couldn't give them margins. And I essentially said, this company, even though it's a growth company, it's a young company, is worth nothing to me. Because in my story, I don't see them turning the corner. So I'm not automatically assuming that every young company is going to turn the corner and make value. That's still a judgment call you got to make. Maybe we'll conclude that Paytm is just a bad model for the Indian payment processing business. Why? Because as I said, UPI has kind of laid the benchmark there, right? If you can transfer money without, is it UPI, UTI, whatever it is? No. If you can transfer money without any fees with a government set up intermediation system, the question you got to ask is, why do I need a Paytm to do these things? And maybe that's the problem here, is you're working in a system where charging money for transactions is going to be very difficult to do. And you're never going to make that take rate that you need to make to break even. And that might be the end game. Paytm is heading towards zero. Abhishek?
Thanks a lot.
Okay.
So, what advice you will give to the students who are in the early stages of learning valuation?
It's incremental, one step at a time. Every valuation you do, you learn something new. So don't try to go from 0 to 100 in 2 weeks. Take it one step at a time. The first time you do it will be difficult. My only advice is don't be in a rush to look up answers. We live in a world where looking up answers is easy, right? Figuring out what tax rate to use, what's the easiest way to find an answer? Go on Google search. What tax rate should I use? There's right there. If you do that, there are two things that happen. One is not everything you see on Google is right? So the answer might be wrong. The second is when you do that, you also have lost a chance to reason your way to an answer. Almost every question in valuation, if you step back and think about what am I trying to do, you can reason your way to an answer. And you know what? That's a skill you need to be able to reason. And we're losing that skill because it's become too easy to look up answers. So in general, try to figure out an answer yourself before you rush off an email or go look up on Google search what an answer is or open up a book. You might reason your way to an answer, go to a book and say, okay, I'm getting the same answer. But the process of reasoning is a learned skill. And if you don't use it, you lose it.
I think we can wrap up now. We are really sorry that less number of people attended today because of the Wi-Fi problem that happened today in IIT Patna. But we are really glad to see the audience from other different colleges today. Overall, on behalf of the entire team of Finance Club IIT Patna, I would like to thank Mr. Aswad Damodaran sir for such a truly insightful session and taking out so much time, uh, around double the scheduled time to share his insights. I'm certain that every person took a lot of learnings from the today's session. Thank you.
Take care. Bye-bye.
Thank you, Madhur, for that. It was very special and very insightful. Thank you.